BTC functions as the benchmark rail for crypto pricing. It is the unit many participants mentally mark portfolios against. That role matters because crowd attention and capital routing often concentrate there first. When BTC advances with steady participation, broader crypto tends to follow. When BTC weakens with abrupt air pockets, the rest of the complex often experiences amplified declines. Demand drivers and narrative rotation. BTC demand typically comes in waves. One wave is strategic allocation from long horizon holders who treat BTC as a monetary alternative. Another wave is tactical flow from traders seeking momentum. Another wave is infrastructure-driven adoption, where access improves through custody, brokerage, and regulated wrappers. These waves can overlap. They can hand off. The handoff is important because trend endurance depends on whether fresh buyers appear after early adopters reduce exposure, supply behavior, and holder composition. The daily need. Coin creation is comparatively small relative to circulating stock, so price discovery is usually a contest over who is willing to part with existing coins. In that contest, cohort behavior is key. Coins held by long-duration owners tend to move less frequently. Coins held by short-duration owners tend to react to fear and excitement. When the share of coins that has not moved for extended periods rises, the float available for immediate sale tightens. When dormant coins awaken during rallies, it can cap upside until new buyers absorb that distribution. Mining economics and network security incentives. Miners are a structural source of selling because they must fund energy and operations, yet their pressure is not constant. If mining margins compress, miners may liquidate inventory more aggressively. If margins expand, they can hold more production. Hash rate growth and fee dynamics also matter. A robust security budget supports confidence, while stress in miner profitability can coincide with higher transfer to exchanges and additional overhead selling. Macro sensitivity without relying on a single indicator. BTC often responds to the cost of money and the availability of credit in the broader financial system, not because BTC has cash flows, but because buyers choose between holding cash equivalents versus taking risks. In periods where real yields are rising and the dollar is strengthening, speculative appetite can fade. In periods where real yields ease and risk assets stabilize, BTC can regain sponsorship. This relationship is unstable across time, so it is better treated as a context filter rather than a deterministic rule. Market microstructure and where moves begin. Large directional swings frequently begin with positioning imbalances in leveraged venues. A crowded long environment can break on a modest downtick. A crowded short environment can unravel on a modest uptick. The practical takeaway is that price can move far even when spot demand is unchanged, simply because forced closing activity cascades. Observing open interest growth alongside rising price variability can help identify fragility, while declining open interest during an advance can hint at a healthier climb supported by unlevered buyers. Technical map built from behavior rather than a single line. Instead of focusing on a single moving average, consider 3 behavior zones. Breakout zones, where price escapes long compression. Acceptance zones, where trading consolidates and value is established. Rejection zones, where rallies repeatedly fail. Breakouts that later return to acceptance and then bounce often indicate a durable uptrend. Breakouts that fail quickly and return beneath the prior range often indicate a false move. Volume concentration is useful here. Heavy prior trading regions tend to act like gravity wells. Thin regions can allow rapid travel until the next dense band. Risk factors unique to to BTC. Custody errors and key management failures remain idiosyncratic risks. Exchange outages can produce temporary dislocations. Network fee spikes can impair quick transfer during stress, and policy actions can influence access in certain jurisdictions. Another risk is correlation spikes, where BTC temporarily behaves like a leveraged proxy for equities, reducing diversification precisely when investors seek it. Practical exposure framework for BTC. A sensible method is to size exposure based on recent price variability, define exit conditions in advance, and separate a core holding bucket from an active trading bucket so decisions do not conflict. For the active bucket, consider scaling entries across time rather than placing all risk at a single level. For the core bucket, prioritize custody, discipline, and a horizon that can withstand deep drawdowns. Avoid building a plan that requires perfect timing. The distribution of returns in BTC is often concentrated in a small number of large sessions. Missing those sessions can materially change outcomes. USDT analysis. USDT is primarily a settlement instrument. It is used as a quote currency, collateral unit, and transfer medium across many trading venues and networks. Its value proposition is convenience and ubiquity. It aims to maintain dollar parity, but that parity is a market outcome supported by confidence, convertibility, and continuous two-way flow. How dollar parity is maintained in practice. USDT typically holds near $1 because traders arbitrage deviations. If USDT trades slightly below, participants can buy it and later convert through available channels. If it trades above, participants can deliver dollars to acquire newly issued tokens or source tokens cheaply elsewhere and sell at a premium. This is not magic. It depends on access, speed, and trust that conversions remain open when stress rises. What can break the smooth functioning? Parity can wobble when redemption routes narrow, when certain exchanges face banking constraints, when market makers reduce balance, cheat usage, or when fear triggers one-way flow. Even if the issuer remains solvent, secondary market discounts can appear if users cannot quickly move from token to dollars. Venue fragmentation matters. A discount on one exchange can persist longer if withdrawals are constrained or if chain congestion prevents rapid arbitrage transfer. Backing composition and convertibility considerations. A stablecoin is only as strong as the assets and processes behind it. For USDT, the main questions are asset liquidity under duress, maturity profile, concentration of counterparties, and operational continuity. During calm periods, these details seem academic. During panic, they become the focal point because holders demand assurance that large redemptions can be met promptly and at par. Smart contract and network layer risks. USDT exists on multiple chains.